Today's episode is brought to you by Bit.com. You'll be hearing more about them later on in today's interview, which begins right now. I have the pleasure of being joined once again by Ronnie Steffele of Incrementum AG. He is joined by his partner, Mark Valek. Gentlemen, welcome to Forward Guide.
Hey, Jack. Thanks for the invitation.
Hey, Jack. Good to seeing you.
So you gentlemen are both very into hard assets, so that's gold as well as Bitcoin. Just give our audience a sense of what you do at Incrementum AG, about the gold report, and sort of why you got into gold and Bitcoin. Ronnie, how about we start with you, and then we'll go to Mark.
Sure. So I started writing about gold actually in 2007 when I was still a young analyst sitting in a bank with lots of hair, and I was super naive when it comes, let's say, to the financial markets. I had no clue about the Austrian School of Economics, which is not taught at all over here in Austria. And I started writing about gold because one gold investment that I had privately did very, very well. And then I fell into this big rabbit hole. And Mark, whom I know from university, he was a fund manager back then, and he started as a hedge fund analyst. And we were still in touch, and then at some point I said, well, did you ever hear about this Ludwig von Mises guy? And he said, no, not really. Austrian School of Economics, it sounds interesting. So yeah, we kind of discovered the Austrian school by accident due to the great financial crisis 2008. And then at some point, if you're going into this rabbit hole, at some point, you feel like the vegetarian in the big butchery, being a hard assets guy, being kind of in favor of a gold standard and sound money while still sitting in a bank. So we've been in discussions for a while to set up our own shop. And then in 2012, we both quitted our jobs. Together with some gentlemen from Switzerland, we founded Incrementum AG. And what we do at Incrementum, it's three different things. First of all, wealth management for high net worth individuals. Then we manage investment funds. So we've got 6 investment funds, most of them, I would say, in the commodities and precious metal space. But we also have 2 funds that actually combine gold and Bitcoin and crypto assets in general. And then the third pillar of our business is the In Gold We Trust report that is now really the most widely followed publication on gold. We just published a new edition end of May, and it's published in German, in English, in Mandarin, and also starting this year also in Spanish. So that's long story short.
Right. May I just add a few parts from my angle? As Ronnie mentioned, I was fund manager and was interviewing all these hedge fund guys at the time where we were discovering the Austrian school. And I always asked the question, especially to macro funds, what about the Austrian school? Do you know about it? And so on. And mostly they said, yeah, of course we know about it. And if you were lucky, they brought up the name Schumpeter, who is Austrian, but not actually belongs to the Austrian school in a narrow sense. But you barely ever heard names like Hayek or Mises. So it was really not known back then, even among the investment professionals, which I found very weird. Especially when it came to the point that after 2008, it became more and more clear to us, at least, that this current monetary system is not sustainable. And you have an edge, actually, also as an investor. That's at least what we think. If you know about the Austrian school, and if you know what is fiat money and what other options could there be, and what are the effects of fiat money. And that was basically also a main driver for us to found Incrementum, because we were actually anticipating that more and more investors will actually think about the non-sustainability of the monetary system and will demand and ask for investment strategies which take these thoughts into account. And I think 9 years later, since we founded, it has become even more clear that this is not sustainable, and more and more people are asking these questions, which we thought they would be asking in the future. And still, I think this thesis is very correct. I think this investors, people in general, will more and more question the current monetary system when it comes to investments. Will think about solutions that take this into consideration, and that is actually what we're trying to offer at Incrementum.
Thank you. I'm going to just read from your most recent edition of the In Gold We Trust report, which, by the way, I really recommend everyone check out. We can put a link in the description. There's a compact version, which is a mere 26 pages, and then the full version is nearly 400 pages, and it features all of these quotes from everyone from John Locke to Taylor Swift. Fantastic charts, so really recommend people check that out. But in that report, you wrote, market participants have been conditioned like Pavlovian dogs to the Fed put. The true costs of this monetary largesse remain hidden for a long time. What did you mean by this?
Well, actually, I think we now really experience what it means for financial markets if the Federal Reserve takes away the punch bowl. I tweeted out a chart today that basically shows how much just in bond and in equity markets. We're not talking about private equity, real estate, crypto, the art market, whatever. Since the beginning of the year, we've seen a wealth destruction. Obviously, only paper wealth of 35 trillion. So that's basically the combined GDP of the United States and China. That's a pretty big number. And I think that many market participants, they were so conditioned, as we write, as Pavlovian dogs, that at some point the Federal Reserve will step in, but they forgot that the Fed put only came into consideration previously when inflation was not a topic. So in 2020, 2008, 2009, actually central bankers were pretty nervous about deflation and disinflation, but not about price inflation. So this is actually the big difference. However, I think at some point, and I mentioned this number, which is really staggering, 35 trillion US dollars, at some point, the market participants will put so much pressure on the Federal Reserve and central banks in general that they will have to reverse. And we don't think we're there yet, but I think we're currently in the process. And I think that the gold market and risk assets in general, they're already kind of anticipating this U-turn by central banks, which is, in the United States, at least some rate hikes have happened, while in the Eurozone, so far nothing has happened. So it's kind of ironic that they will have to make a U-turn before they even got started. And this is exactly the scenario that we described in our book, in our second book. The first was called Austrian School for Investors. The second was called The Zero Rate Trap, which was published in 2019, where we basically laid out the case and said, well, the higher the debt levels are, the higher the sensitivity to rising interest rates. And as we're seeing an all-time high, obviously in global debt, the sensitivity to rising rates is higher than ever. And I think we are already in a recession in the United States. We are already in a recession in the European Union. And therefore, I think we will have to expect at some point very, very aggressive measures by central banks. And, I think it's not a coincidence that our reports are called In Gold We Trust. And we wrote one report about the very, very important topic of trust and how it affects our lives as, family fathers, as businessmen, as members of society. Trust is really crucial. And I think that trust in central banks has deteriorated significantly. And I think the credibility that for some reason central banks still have, I think within the course of this upcoming U-turn, it will suffer tremendously.
I got tons of questions. You rightly point out that for the past 40 years, the trend has been that in each cycle, the Federal Reserve cuts and pivots at a lower level of interest. And the last level was 2.75% or somewhere around there in the Powell pivot of December 2018. So do you think that the Federal Reserve will fail to get to even that level of 2.75, given that they indicated they want to go higher and the terminal rate is somewhere like 3.75%? And might I also add, what do you think would be an appropriate rate of interest to contain inflation? I don't think you think it's 1.75%. Clearly, it's not zero. Is it 4% sufficient, or would the Federal Reserve have to go to 6%?
I think that, over the last couple of weeks, we already saw quite a move, and we're seeing that the expectations for next year actually got lowered significantly. So I think the market, and even especially Jay Powell, I think he realizes that the recession clouds are getting darker and darker. Now, I think it's this U-turn is not one moment. It is a process, and I think we're at the moment right at the beginning of the process. Now, I think that gold, if you have a look at a chart showing gold and real yields, I think that actually based on real yields, gold would have to be $200 lower. So my interpretation would be that actually gold is kind of calling bullshit on the rate hikes, and as we write in the report, everybody kind of wants to believe that central bankers are now really turning hawkish, but they're only hawks in dove's cloth. So what's the right rate? I don't know. I just see that this massive interplay between asset price deflation and consumer price inflation, I think this is really crucial to understand at the moment. But at the moment, based on our incrementum inflation signal, we clearly see that probably for this inflation wave, we've seen the highs. I think that if you have a look at, copper being down 22% from March highs, aluminium down 40%, nickel 54%, lumber 60%. If you have a look at energy markets, of course, there's a big political premium, but still, at 120, Brent, failed to take that level out. If you have a look at equity sectors, automobiles down 40%, home building down 36%. So we are already seeing recession moves in financial markets, and those moves are disinflationary per definition. Therefore, I think that inflation numbers will come down over the next couple of weeks, and this will also give central bankers lots of leeway, and they can say, well, we did a great job. We orchestrated a soft landing, and everything's going to be fine, and we don't have to hike that aggressively. But I think it's already too late, because they already broke so much. It will be hard to reinflate this bubble.
Just adding a few thoughts. When it comes to what is the correct interest rate, obviously we are leaning to free market economics, and it's very much contrary to our philosophy to think that anybody can know what the right price is. Just this has to be said, I think. But if one starts this guessing game, or if one perhaps looks at history, what happened in previous cycles, obviously the big example was in 1980, the pivot of Paul Volcker. What happened there, and I think it's probably not so important what the nominal rate is, but I think it's more important what the real rate is, right? So if you say 6 or 8% or 4 or 6, whatever, the question is what is the interest, the inflation rate at that point? And currently we have so many moving parts. Obviously, we have this geopolitical problems in Russia, which have severe consequences on energy markets and commodity markets in general, which again have consequences on price inflation, which then again have consequences on the real rate, right? So this is one big question mark. How will this resolve, or how will this go on? If there at some point could be some kind of relaxation on that front, that obviously would help in terms of real rates. If commodity prices come down, you could have some kind of softer commodity prices, and then you have the basis effect. So that would actually be similar to a real rate increase if everything else stays the same. Commodity prices fall, and you have the base effect, and then price inflation comes down from 9 percentage points to 6 or even 5 or 4. Then actually you actually have kind of a real rate hike, even though the Fed may do nothing more, right? So a lot of moving parts on that front. But I think one thought is also important still at this very stage. We are coming from decades of disinflation, this great moderation. We wrote that we think that this is ending, or has ended actually. And when this ends, and when this inflationary environment holds on, keeps on for longer than perhaps we are now currently, or the mainstream is now anticipating, I think the problem really could become very bad when this inflation expectations get anchored on a higher level. So in this precedence, I actually agree with the framework of central bankers. They really have to make sure that this inflation expectations don't go up too high, because the higher the inflation expectations are for the longer run, the more difficult the task of actually bringing down the inflation gets. So I think this point in time is crucial when it comes to trying to save the fiat money system at the end of the day. And I think the Fed is absolutely right that they are very hawkish, although one can debate on very hawkish or not, but at least relatively hawkish compared to all other big currencies. The question is if they're going to be able to follow through, and if they are not provoking asset price deflation that is too bad. And this is extremely exciting, this kind of setup, and we lean towards the opinion that we probably are going to experience further turmoils on the asset markets, which then again will probably give the Fed a very tough time to actually follow through what they have basically communicating.
I'm curious, do you think, the disinflationary scenario, if the CPI goes from 8.5 back down to 5%, but stays at 5%, that's very different than 8.5 going down to 2%. So if we're in that world where long-term inflation is sort of at 5%, and medium-term, long-term inflation expectations, as you say, Mark, are also unanchored, isn't that such a disaster scenario that you think the Federal Reserve would continue to tighten monetary policy? I'm a little surprised, Ronnie, to hear you say that you think the Federal Reserve will relatively pivot so soon, given I think in the Fed's monetary policy report, it just said that the committee's commitment to restoring price stability is quote, unconditional. So tell us, why are you skeptical that the Federal Reserve will follow through, both on rate hikes as well as QT?
Well, they have already pivoted. I think Dave Rosenberg wrote about that recently, at points where inflation rates were significantly above 2%. So I think for them it's not the absolute level, it's direction. And from my point of view, I think what's important to say is that I think that this great moderation, as Mark said, this is basically over. So our take is basically that inflation and following inflation and structuring your portfolio based on the topic of inflation will become much more important going forward. Because let's face it, we've had basically 40 years of constantly falling inflation rates. No investment professionals at the moment that are active as wealth managers, as fund managers, whatever, really know how to navigate in an inflationary environment. So I think this is really a new environment that we're in, and we should not forget, Jack, that actually this is exactly what central bankers kept telling us, and what actually politicians wanted to achieve to reduce their debt burden. And if we study history, if we study, for example, the period after the Second World War, where we saw enormous levels of debt. Financial repression, deeply negative real rates in combination with high growth rates were basically the solution to the debt problem. Now, obviously, compared to the time after the Second World War, there are now huge differences when it comes to growth, when it comes to demographics, when it comes to the financialization of our system. But I think, if I was a politician, I would be quite happy about seeing inflation numbers between 3 to 6% over the next couple of years. The problem is that this in theory it works probably quite well, but in practice it doesn't. And what I experience over here in Europe is that we are now really starting to have a inflation mindset. And I think that inflation still very much is a psychological topic. Now, if inflation expectations should really become unanchored, and this is the biggest fear of central banks, then obviously we've got a big problem, because if we all expect inflation numbers to remain high, this affects our behavior as as consumers, as business owners, as investors tremendously. Now, I think what's really interesting is this divergence between what financial markets are seeing. So if you have a look at 10-year break-even inflation rates, they were at above 3% in April. Now they are at 2.5%. So they came down quite a lot. If you have a look at 5-year inflation expectations, they also came down significantly. But on the other hand, if you have a look at University of Michigan inflation expectations, so basically what consumers are expecting, they're at 5.4%, which is the highest since 1981, and they're still rising. So I think this current divergence is really interesting to follow. And going forward, probably the last shoe to drop that we would have to see for falling inflation rates would be oil prices and energy prices. So far, we're still trading at 112 for Brent, but as I've said, we couldn't take out the 120. I think this is really crucial to follow, because elections are being won and being lost at the gas station, and probably also in the supermarket. And we all know that there's midterm elections coming up. So inflation definitely is a very, very political issue at the moment. But on the other hand, I don't think that Joe Biden and the Democrats really want to see the S&P down even more. And baby boomers, they're now retiring. Having a look at their investments being down 30% plus 8% inflation on top. That's a pretty nasty wealth destruction over just a couple of months. So long story short, I think, Jack, it's for us as asset managers and as well as writers, it's a very interesting and stimulating environment. However, I think for the mainstream investors, for people that don't follow markets like we do, it's a very, very dangerous environment.
I think one can really measure or experience which kind of environment one is if one basically listens to small talk. If people are people talking about inflation, or aren't they? Right, and then I think people will be still talking about inflation if the official inflation rate goes back to 5 percentage points or even 4. Perhaps financial market participants will already be cheering and saying, "Hooray! This inflation is going away and everything is going to be normal in a few quarters." But I think psychologically nothing will have changed yet if prices only continue to rise at 4% after they have risen 9 percentage points perhaps last year. I think the inflation topic still will be a topic in the general public, and the inflationary period really only will end once people stop talking about price inflation. This is, I think, really a rule from real life, not so much from financial markets.
I've got an interesting question, which is, let me step into my time machine portal, and I'm going to go back to January 2020 when gold was about $1,500, $1,600, and Bitcoin, I believe, was about $7,000 or $8,000. And I told both of you what happened. There was a huge pandemic, and as a result, governments and central banks printed a lot of money. There was commercial credit bank creation that was forgiven by the government, and a ton of money printing. Where would you, if I told you that, where would you have said gold and Bitcoin would have been at this stage? How about Ronnie, you say gold, and Mark, you say Bitcoin?
Obviously, Jack, I would have called it exactly. I mean, it's very easy. Difficult question. I mean, what I can say is basically at that time around, we started our fund strategy, which combines Bitcoin and gold. And so that was, I remember very lively still, and it was in February when we started. What we did, I think, see correctly back then, since we had very memories of the financial crisis still, we knew that this is a real threat in terms of a deflationary event which is now hitting the global economy. And we also think that a deflationary threat is actually can be crucial and fatal to this debt-based monetary system. So debt deflation is actually a real threat to this system, and with this knowledge, we basically could anticipate that they will throw everything at it to keep this system from imploding, and that gave us the confidence actually to start the fund and build up the exposure. And I remember when Bitcoin futures were at 4,000, I was buying. I mean, obviously, it's if you buy into this falling knife, it's a weird feeling, but still, we incrementally started the exposure because that was just happened to be the time when the fund started in February, March 2020. And we didn't have any fear. I mean, yeah, we were excited and everything, but we almost were certain that this will reverse, since they were printing trillions and the amount had even doubled and tripled relative to the last financial crisis, and we thought there will be no limits. They will print so much until they turn these markets around. So I definitely couldn't have told you the price where Bitcoin is going to be, but we were both so certain that as well Bitcoin and gold would be much higher. Bitcoin turned out to be much higher. In the meantime, it fell a little bit, but it's still much higher than back then. Similar story to gold, actually. So can give Ronnie the word regarding gold, but would you have known, Ronnie, where gold price would have been?
Well, I think it's in Back to the Future, second part. Do you remember it, where Biff gets this sports almanac, and he basically knows all the sporting results of the future, and then bets on it, and becomes a rich man. Well. Actually, we don't have such we don't have a DeLorean, a time machine, unfortunately. But I think what we know and understand quite well is financial markets history. And therefore, for us, I think it was not a big surprise that central banks would step in very, very aggressively. And this time around, it wasn't just central bank policy, it was also massive fiscal stimulus. I think that was the big change compared to 2008, 2009. And I think it wasn't, in 2008, 2009, I think, the system or markets were not really well prepared to such a crisis, and there were too few firefighters, and they came too late, and there were so many measures being taken by central banks, but it took ages. Now I think we haven't seen a lack of firefighters in 2020. Actually, they did probably way too much, and then they were lazy taking back their measures. And we wrote a special report on inflation in fall 2020. It was called "The Boy Who Cried Wolf," where we expected price inflation to surge. However, when it comes to the price of gold, I would be a liar if I would tell you, Jack, well, I at the beginning of 2020, when gold was trading at I think 1500, 1550, we started into the year, and you would tell me what's going to happen. I would be a liar if I would have told you, well, I think 1800, that's going to be the price level. But still, I think, people kind of, it's all about managing expectations, and I think that gold actually kind of did not a tremendous job, but it did okay, especially in these very, very volatile weeks of 2020 in spring. I think gold stabilized your portfolio. Gold did really well. In an environment of negative real rates. I think gold anticipated a rising inflation very early on. And it also did a good job in 2022. I mean, we have to say that we almost did hit new all-time highs in US dollar terms in spring. We did hit several new all-time highs in euro terms, and have a look at the price of gold in Japanese yen terms. And we always say that our friends in Japan, they're a couple of steps further. And you know what's going on there, and we've got a big trade set up based on this monetary madness going on. I think it's no coincidence that the Japanese yen is so weak, and that gold actually in Japanese yen terms is up almost 20%. So I think gold did okay, but still, to be honest, I would have expected a little bit more.
And would you say if there might be a reason as to why it didn't perform as well as you would have thought? And again, of course, this is all hypothetical. Would it have been that the economic recovery was very robust, so we were in more of a reflationary environment than a stagflationary environment? Or am I sort of reaching?
Well, I think that's definitely a topic. I think we should not forget that last year the S&P was hitting, I think, 68 new all-time highs. I think that Bitcoin kind of stole the show from gold last year. I think it's a bit exaggerated that it's stealing too much investment flows from gold. I think it's mostly media kind of appearance, stuff like that. And then we shouldn't forget that, the 2019 and 2020 performance was really good. Gold was up 19% in 2019. It was up 25% in 2020. So last year in dollar terms, it was down 3.5%, which is okay. I mean, it's been taking a breather. And I think people tend to forget that we are in a brutal bull market for the US dollar that works like kind of a wrecking ball for markets all over, for risk assets, for emerging markets, obviously. So at some point, obviously this will change. Probably this will go hand in hand with the point when Jay Powell has to pivot. But it hasn't been recently, especially in 2021, it hasn't been such a great environment to some degree. But let's talk about the future. I think if you have a close look at the Commitment of Traders report, this is a fantastic setup. And I think that, as I've said before, having a look at real yields, I think that gold, based on real yields, which explain quite a lot of the gold price development, it actually should been significantly lower. And the fact that it's holding up so well, even in dollar terms, I think that's I would interpret it as a sign of strength.
Right. See, just want to clarify a few points. The first is when a lot of people who view this, who like me are American, they think, oh, gold, it's been all right year to date. But you're saying priced in yen, priced in euro, gold has been an extraordinary performer because those currencies have been weak against gold as well as against the dollar. Gold relative to the dollar has been roughly flat this year, which doesn't sound great, but people should keep in mind that the S&P 500 is down 20%. Long duration treasury bonds are down 30%, maybe a little bit more. And then, of course, the 60-40 portfolio, where 60% stocks is supposed to be helped by 40% bonds, those have gone down together. So it's been one of the worst years for the 60-40 portfolios. Ronnie, I want to bring you into this conversation. In what environment do you think Bitcoin performs especially well? Is it one of sort of suppressed real yields, or is it and is it different than things that are good for gold?
Yeah, I think what one can observe when it comes to Bitcoin, it has become, obviously, in terms of market caps, more and more bigger. I mean, over the years, not this year, but so it has become a little bit of a macro play, maybe a stretch, but it is partly, at least in the universe of institutional players, and once it enters this sphere, I think it gets more exposure to other macro factors, right? So when you think about Bitcoin, when it was in the early stage, when it had, I don't know, the first two bull markets, the market cap, I think, was perhaps first one 50 million or so. Second bull market was perhaps 300 million or so, and half a trillion. I think we only reached a trillion in 2017, barely, not sure, and we are back below a trillion now. So it has become significantly larger every time, and that's why it's more. I think real rates are more and more relevant to Bitcoin over the years. One could make the argument at the end of the last bull market, 2017, when we remember back, we were in this hiking process, that this also was part of the reason why the bull market ended. Although if one looks at the bull market and is really honest, it became very enthusiastic and publish, I would say. So it went ahead of itself, I think. But still, the rising interest rates probably could have brought it to an end. And I'm pretty sure that this time around that was definitely a case, because I think the high was in November 21, and that was actually pretty much the time where the Fed started, at least verbally, their normalization process when they retired the word temporary. I think that was exactly in November 21 when they were not longer talking about temporary inflation rates, which was the first signal to the market that they perhaps will raise interest rates. So that coincides pretty well with the high point. So yeah, I think real rates do play a role. But what I also think is in both cases, actually, although we have seen pretty negative correlation lately between gold and Bitcoin, but in the longer term, I still think that inflation expectations are very important for both assets, and longer term inflation expectations haven't gone up very much. They've been coming down again. So that's I think definitely part of the reason when it comes to gold, also why this lackluster performance has taken place. And if these inflation expectations would rise again, I think Bitcoin has a good chance to profit also from that. That's only one factor. That's surely not the determining factor. But generally, obviously speaking, I think an inflationary environment and negative real rates are tailwind for Bitcoin.
Today's episode is brought to you by Bit.com, a leading cryptocurrency trading platform. From spot to futures to options trading and more, Bit.com has it all. So whether you're a seasoned investor or you're new to the game, you need to be on Bit.com. Bit.com has launched a zero-taker fee option campaign until May 10th. To enroll, email VIP@bit.com. That's bit spelled B-I-T. So email VIP@bit.com and tell them I sent you. And Mark, might I ask, I know you've done a lot of in-depth technical work on Bitcoin, on the cycles, on liquidity. What is your outlook over the next 3 to 6 months? And when do you think a new bull market could be here? Or is it too early to say that? Based on the very, very rudimentary analysis I've done, I know that, the last bear market lasted about a year. So, how long are we halfway into a bear market? How are you sort of thinking about, the next 6 months?
I mean, I think even though now lately he has not been given so much credit, Plan B's model, I think still has value. Maybe he personally became a little bit too bullish and at the end of the bull market last time around. But if you just look at what the model said, and when it comes to the cycle, I think the timing was actually quite well again. And the high point, perhaps the model suggested the high point being a little bit higher, but just when it comes to the timing of the high, one could, I think, make the argument that this model still is very much in play right now. And if one takes that as some kind of a starting point, this bear market again is moving along the lines as the last bear markets. And I think according to the model, at least according to the last two cycles, halving cycles, we would be seeing basically, if we see some kind of a repeat again, a low point in November. So that's one rough indication which one could, I think, have in mind. Obviously, probably will not be November exactly, but just roughly in fall. I think that could make sense. And also, I think just when one looks at general sentiment indicators or anecdotal evidence, I think we saw a lot of crypto projects which obviously also again were too enthusiastic, and there were actually no significant value could be made, and these are exposed now. So this crypto cycle and Bitcoin cycle is very rough, but it's also very fast. So the cleansing goes through pretty fast. it's probably too short to call the bear market ending already now. I would say just from the duration of the bear market, we probably need a little bit more, I don't know, pain, but at least more lack of interest, where everybody really only the hardcore bulls remain. And perhaps one also needs a real super capitulation. I think we didn't see that yet. I'm not calling for one. It could also just like end in kind of non-interest, this bear market, but there could also be obviously a final sell-off, which we haven't seen yet, I think. So I think both of these thoughts would point to not the super recovery very short term, but obviously if you have the other point which we have talked about, which would be kind of the pivoting of the monetary policy, and perhaps a sell-off before that could be a really nice setup for reversal and perhaps the next bull market in the second half of this year.
Right, Mark, and thanks for that. I think it's very prudent to definitely not call a bottom in any asset. It makes a lot of sense to me. Mark, my question is just to get a little bit more specifics. Is there a certain level on Bitcoin in terms of price in dollars or euros, or time, you said November, or something else that you would see as a very clear capitulation buying signal, such as the sign that you saw in March 2020?
Yeah, when it comes to price levels, I do watch some levels, and this is also only a very, very simplistic rule, which I came up, probably others also think similarly. But I think one way to basically manage this exponential performance going up and down is not thinking so much in percentage terms, but like in how often the price has doubled, and when it goes down, how often it halved. So not to be confused with the Bitcoin halving, just the halving of the price, right?
Yes.
And when we saw 69,000 roughly at the high, we've been coming down we halved once, then we would be somewhere in the mid 30s after one price halving, and the second halving would be between $15,000 and $20,000. Yeah, and then the question is, if we look at the previous bear markets, we had three and maximum four halvings almost. So the first one I think was four halving, and then it became less and less. And I think if we have two price halvings, I think that's quite a severe bear market at this point at this stage. So that translates to price levels very roughly. Obviously, this is only very roughly, but just to have some kind of framework. This would be prices between 15K and 20K. So not so much lower actually. I would doubt that it goes to a third halving. So I would doubt that we see prices sub 10K. I don't think so. Everything is possible, obviously. But as I said, I think that's also the level, when people really have some kind of capitulated. If you have, like, if you're coming from 40,000 and now say the price is 17,000, 15,000, you barely don't even care if it goes down below 10,000 or not, but that would be significant. It would be another halving, right? If you have 18,000 and go down to 9,000, that's another minus 50%. And people, I think, don't think like that when they're really so deep in the red, and they have kind of capitulated. So I'd say 15,000 I'd definitely buy. Between 20 and 50 I'd buy.
If I may add, Jack, I think it's crucial to say, and that's our approach. We actually enjoy the volatility of Bitcoin, as we are basically harvesting the volatility of Bitcoin via our option strategy, and we are rebalancing within our funds. So it is not a stubborn long only strategy where we say, well, Bitcoin will go to the moon and that's it. I think we've got a slightly different approach to many people in this industry. I think when it comes to Bitcoin itself and also to gold, we discovered Bitcoin in 2012 or 2013 through our knowledge about gold and contacts in the libertarian scene. And for us, it took a while to really understand it, but then I think we realized that it is actually, there's many similarities between gold and Bitcoin, and the most important one obviously is the stock to flow ratio. So you can trust, based on geology, that the supply of gold will not double over the next couple of weeks, month, whatever. So gold is limited by geological restrictions. It is just much harder and more expensive to mine gold. And on the other hand, you've got a very similar thing when it comes to Bitcoin. And we know that at the moment, the stock to flow ratio, or let's say the inflation rate of Bitcoin and of gold, is basically at the same level, 1.6%. And with the next halving, Bitcoin will be a harder currency than gold. Now we think that, if we had if we had sound money, actually there wouldn't be any case for holding gold or for holding Bitcoin. Probably this Satoshi Nakamoto, whoever it was, if we had sound money, then probably nobody would know who Satoshi is, and there wouldn't be any Bitcoin. But I think from it is crystal clear that as some sort of a hedge, as a monetary insurance policy, I think both totally make sense. I think that when it comes to price, or let's say when it comes to the future of Bitcoin, usually there's three things that really are essential. It's volatility, it's price, and the correlation to other assets. In the case of Bitcoin, I think we should not forget the fourth parameter, which is the adoption rate. And I think the adoption rate is still very, very solid. I see that the whole Bitcoin ecosystem is growing. I see that Bitcoin is attracting so much capital, but so much human resources. I think this is really important, that it actually behaves like a, how do you say, like a magnet for young, ambitious talent going into this sector. And I have to say, if we attend conferences, the smartest and also, the most ambitious, hardworking, also the craziest guys, obviously we meet at Bitcoin conferences. So therefore, I think, we regard it as rather binary. So in 10 years from now, Bitcoin can either be worth zero or it will be worth $1 million or even more. But I think if this adoption progresses like it does at the moment, I think the scenario that Bitcoin will be at zero in 10 years is becoming much more less likely. So therefore, I think that makes us pretty confident going forward. And when it comes to the sentiment, in newspapers, and also people that actually hate Bitcoin, because for some reason everybody has to have an opinion on gold and also on Bitcoin. It's a bit different to convertible bonds or I don't know 10-year treasuries. Nobody cares about them, but when it comes to gold and Bitcoin, everybody has to say something, and it's either very, very positive. So those are the gold bugs, or the Bitcoin maximalists, hodlers, whatever, or there's the haters camp. Yeah, there's nothing in between for some reason. But I think the over the last couple of weeks, we saw that the sentiment in the space is already very, very negative. So therefore, I would say that we're closer to the bottom.
Right. So yeah, Bitcoin and gold are fundamentally similar in that they're forms of hard money, but they can trade very, very differently, as we've seen over the past 2 years. They diverged in August of 2020 when Bitcoin, continued on its bull run when gold sort of faltered. And likewise, over the past 8 months, Bitcoin has entered a bear market where gold has done well relative to other assets. So I forgot about the fact that your fund, an Incrementum, you rebalance. I can imagine that has been very helpful because people who've been 100% long gold or 100% long Bitcoin, they've at some point they've suffered, and so I definitely can get the advantage of rebalancing. So Ronnie, it sounds like you and Mark are very long-term bullish on Bitcoin, but short-term there's still a little bit of a shakeout happening. What about gold? I get the sense, Ronnie, that on gold you're bullish, not long-term bullish. You're bullish now. You're sort of ringing the bell for gold right now. Am I right about that? And sort of like, what's your outlook over the next 6 months? And please feel free to draw in whether it's the central banks, it's money printing, or it's the Russia's invasion of Ukraine.
Well, I think I'm short term. I think that it's a healthy risk reward ratio, and long term I really don't like the term gold bug. I think it's just an appreciation of monetary history that we have, an understanding of monetary history, and I just don't see that our monetary history, our monetary system will go down in deflation. It has always been inflation, and us being from Austria, where we had the hyperinflation, and then Germany followed with their Weimar hyperinflation. I think this is still in our, as I've once said, in our monetary DNA. So let's face it, if the case for gold and for Bitcoin basically stops, that would mean that we've got sound money, that we've got healthy interest rates, that the debt situation isn't a problem at all, that we've got a free capitalist system. Well, actually, that's totally fine. We're not married to gold or to Bitcoin, just to our wives, and so I think at some point probably we will say, well, let's lower our gold allocation, but I think we are not at this stage yet. And we had a great interview with Fofoa, which is kind of a mysterious, legendary blogger who has really. It's a very interesting blog, and he calls gold a singularity hedge, and he says, well, actually, you only need one revaluation of gold in your lifetime, and actually, Jack, I'm not sure, to be honest, if the euro will be around in 5 or 10 years. I'm slightly more sure about the US dollar, but actually for both currencies, I just don't see that the purchasing power measured in various goods will increase significantly. Now, I believe that gold is doing its job pretty well to protect your purchasing power. We've got this famous gold beer ratio where we show the purchasing power of 1 ounce of gold at the Munich Oktoberfest, where you see inflation rates being significantly higher than official inflation rates. And actually, we haven't had a Oktoberfest in Munich for 2 years, and actually the price of one Maß, which is one liter beer at the Oktoberfest, I think it's up 19%. So 1 liter is roughly 14 euros. So actually, in gold, it has. The purchasing power is pretty stable, and I think this is really the job of gold: protecting your purchasing power, protecting your hard-earned money, and this is, from my point of view, that this is really crucial to understand. Then obviously you can also trade around gold. You can invest in mining stocks and so on. This is what I would call more of a performance gold compared to insurance or safety gold. But I think going forward with the whole de-dollarization going on, with the huge turmoil that we're seeing now in terms of geopolitics, I think that the world will, going forward, it will need internationally recognized anchor of trust. And I think, gold is neutral. Gold doesn't have any counterparty risk, and it is actually one of the most liquid assets worldwide. It traded 150 billion US dollars on a daily basis last year. So it's extremely liquid. So I think at some point where we really see that the world is breaking into at least two different blocks, I think that the role of gold as in this monetary multipolarity will increase significantly, and I think what's really gonna be moving the needle will be investors' demand. Check. So I think that now we're close to the end of the second quarter. I talked to many private bankers, and the first quarter was a disaster. So their balanced portfolios were down like between 8 to 12%. Second quarter, even worse. I think Jim Reed just came out saying that we're experiencing in global or in US bond markets, it's the worst start into the year, or the worst performance year to date since 1788. So then you get, second quarter being down significantly. Now, what are asset managers gonna do after 25-30% negative performance plus inflation? I think that many will rediscover gold, and it used to be like, well, we recommend our clients holding 1 to 2% gold in their portfolios, which is absolutely nonsense. It doesn't really move the needle, and you don't have to have 50% gold. But I think that 10-15% will become, and this is also a process, this will kind of become standard. So gold is moving, or is becoming from a, let's say, more of a satellite investment. It's going into the core, like it was in the 1970s. So I think, therefore, that makes me pretty confident. Timing wise, as I've mentioned, the commitment of traders report is really exciting. So that's a very, very strong foundation. And let's face it, we're not so far away from all-time highs also in US dollar terms. So as soon as the dollar should start to weaken, which is going to happen at some point, then I think, if we tackle new all-time highs, then basically the sky is the limit. And what's very important, on an inflation-adjusted basis, if you compare it to 1980, gold is still really, really inexpensive. So it's not a it's not an expensive price level that we're talking about at the moment.
And Ronnie, when you say you look at the commitment of traders data and you like what you see, is that because a lot of people are buying it, or people aren't buying it, so it's a counter trend signal?
Well, it's basically, you're seeing that small speculators, which is, I don't know, it's basically the retail investors primarily. They have thrown in the towel. On the other hand, commercials have significantly reduced their short positions and increased their long positions. So from my point of view, the commitment of traders report is, it is not really, it's not a timing indicator, but it tells you where we are roughly in this cycle. So it basically tells you, well, the dinner is already prepared, but nobody said, well, come to the table, dinner is served. So at some point, we will get there. And as we've said previously, I think this will go hand in hand with this Fed pivot that will happen at some point.
Ronnie, so dinner is served. So gold investors, sounds like they will have a nice feast if the Federal Reserve pivots. If the Federal Reserve doesn't pivot, or rather, if they don't pivot what we would consider soon, if they get to 4% and then stay at 4% for a while and then gradually cut later, and they do hike monetary policy, they do hike rates, what's your outlook on gold then? If the Fed does sort of increase the short-term rate a lot to 4%.
Well, that's obviously not a super bullish environment that we would be in. I wouldn't expect gold to go higher, sideways at best, or probably lower. But I think we also have to ask ourselves what this would mean for the rest of the market, what it would mean for bond markets, what it would mean for equity markets. Real estate. I mean, I think that, as I've said previously, I think we are already in a recession. We expect the ISM to go below 50 over the course of the summer, so July or August probably.
The
So
US ISM,
and
the
we've
United States or Europe or US?
yeah, for the United States, and obviously, having a look at what's going on over in Europe, I don't think that we're doing so much better, and therefore, I just replied to a tweet from an economist, from a big international bank over here in Europe, and he said, well, a recession is not our base case, but still, for 2023, recessionary risks have increased a bit. From my point of view, that's that's like saying that Austria, I don't know, will win the World Cup in soccer. It's just, it's not gonna happen. We are in a recession. Jack, I think it's important to say that before 2020, I think we saw the longest expansion for the US economy in the history of the United States. And then we saw this very, very brief COVID recession that was basically papered over by enormous amounts of fiscal stimulus and monetary stimulus. So we weren't really able to see the liquidation that normally happens over the course of a recession. We haven't seen any major bankruptcies over the last couple of quarters. So we've been in this la land for quite a while. But I think at some point a recession is going to hit the market. I think there's lots of malinvestments that will have to be liquidated, and we know that central banks won't say, well, let's let the recession cleanse everything out and start some sort of an Austrian laissez-faire approach. But I think, from our point, and this is really crucial for us, a recession isn't something that we would fear. It is something that obviously changes and improves the capital structure. It means losses for many people. It means higher unemployment, absolutely. But I think it's important for an economic cycle. And central banks try to destroy the cycle by keeping us on a constant level, but that's just not healthy. Like for every human being, if the temperature is kept at, I don't know, 22-23% all the time, you will struggle once it's colder or once it's hotter, and you will have to put in enormous amounts of energy to keep it at a stable temperature. So, yeah, therefore, long story short, if we continue raising rates, then obviously it's not a super bullish environment for gold, but I think it's even worse for other asset classes. And we haven't seen any major disruptions in real estate yet. And we haven't seen anything in private equity yet. And I think this is really what's gonna what we can look forward to over the next couple of months. That's gonna be interesting. What's gonna happen in more illiquid spaces of the market?
Yeah, if we get to 4%, I would be very surprised if S&P 500 did better than gold. It could happen. Anything can happen. I want to ask you, where do you think, at what point do you think the Federal Reserve will pivot? Because right now I'm just looking at the forward interest rate futures curve, and by October of 2022, so in only a few months, the Fed funds rate is projected by the market to be about 3.1%. Do you think it gets there, and do you think like a pivot happens before that? Because that means a recession would have to happen pretty quickly.
Well, I think what you could watch is the asset markets. I'd watch the VIX index. I'd watch the levels of general stock markets, and I would very closely watch credit spreads. So as long as these indices or measures don't go out to rather extreme levels, I think the Fed will stick to their guns and they will raise, because they are serious. They know the predicament and they know they have to act now. And I think they are actually also regaining some credibility, at least on a relative basis. I mean, the Eurozone really is looking ridiculous versus the Fed, or versus the dollar. So in terms of financing also, if one thinks about the reserve status of the US when it comes to the Western world, obviously the US is the go-to currency and will stay the go-to currency since they've been able to hike, and I think that's also an advantage which they have in mind. But as I said, when it comes to these measures, VIX, general stock market levels, and credit spreads, when things get too dicey, I think they will hit the pause button at least. And if things get even more dicey, they will reverse. I wouldn't give any credibility to words like unconditional. I mean, we saw this movie. We heard it. Will be watching it like paint gets dry, or what did they say last time? And when the minute things were bad, they pivoted, and this will happen again. I'm sure about that. But for now, as long as the pain is bearable, they will continue to raise.
Right. Mark, does that change? I'm sure that if inflation moderates, I'm sure you're right. But what if inflation stays stubbornly high at 6 or 7%? Does that increase? Does that mean that there has to be more pain than there was in 2018?
Yeah, it probably means that. So the dilemma is even bigger when the inflation is higher. But when push comes to shove, they will have to save basically not only the financial markets, but this time what they're actually saving is the state. So you have to keep the state, the federal level in that sense, able to refinance the debt, So if they provoke a too big of a recession, I mean, one should keep in mind that the tax receipts correlate 1-to-1 to the nominal GDP. So if nominal GDP shrinks, then obviously the income of the states and also the federal level shrinks as well. And I think that's the real predicament they are in, because if they raise the interest rates, not only do they tighten the financial conditions for refinancing the huge amount of debt, but also by throwing the economy into a recession, the tax receipts massively fall. And I think hereby lies the real problem this time around. Not so much perhaps in the first point of view the financial markets, but the solvency of the federal level. And if push comes to shove, they will have to save it. It's clearly to me they will not provoke a bankruptcy or any kind of default. And therefore, when push comes to shove, they will reverse the policy and they will keep enabling these kind of debt policies.
just to add one number, I think Luke Roman tweeted that out. U.S. federal tax receipts in May down 16%. So yeah, I mean that screams recession already, and yeah, I was shocked when I saw that number, and I don't expect June to be significantly better.
Yeah, well, I think also Luke has pointed out that Social Security and a lot of benefits programs are tied to inflation. So really, you could argue that the most expensive thing for the government, for the U.S., is to have high inflation. So it's interesting. But Mark, I've got a final question for you, and then I'll give the last word to you, Ronnie. Mark, how severe of a risk or threat would you say is holding cryptocurrency or Bitcoin not in a cold storage, but holding it on an exchange or holding it on a platform where you're lending it out to a third party? You know, we've seen some platforms reduce withdrawals, and it's essentially like, you know, everyone looks at Bitcoin as it's monetary autonomy, but then you're essentially tying it at a company that's like a bank, but you don't even have FDIC insurance. So yeah, do you have a comment on how people should be thinking about the risks of holding things on exchanges on hot wallets rather than cold wallets?
Yeah, definitely on a cold wallet, sure. I mean, you can trade it on an account, but then you have to know what your risk is. So keep your Bitcoin on a cold wallet. I think that's a very short answer. Yeah, nothing more to say.
There we go. All right, Ronnie, can you tie a nice bow on this conversation for us? Tell us, where are we in monetary climate change, stagflation, and just your outlook on hard assets?
I mean, we wrote roughly 400 pages about that. So if you need some good reading material for your summer vacation, feel free to have a look at the extended version of the In Gold We Trust report. I think it's, you know, from a macro perspective, it's a super interesting environment. However, we should not forget that you know, we're talking now about very sophisticated and superficial topics, but on the other hand, inflation is a very, very yeah, how should I put it, a nasty tax, and especially for the poorest. So I think, you know, this environment that we are currently experiencing, this will obviously have a big impact on election results. It will have a big impact on politics. I think, you know, we are already quite divided and a very polarized society, and this is further increased by inflation now being at these levels. So I think we should not forget about the social consequences of the environment that we're in, and we should not forget there's many people and families at the moment out there who really have a very, very hard time making ends meet. When it comes to the big picture, I think that, you know, if we study the rescue packages of central banks, I mean, it's obvious that every round of quantitative easing became bigger and more aggressive, and quantitative tightening, well, actually, you know, it didn't really turn out that well. And I think over the course of the Federal Reserve, there were 4 or 5 episodes of where they tried to reduce the size of their balance sheets, and basically all of them ended in a recession. So I think it would be naive to think that they will not step in for another round. However, it is clear that the toolbox of central bankers is quite empty these days. You know, going to negative rates in the US, I really don't see it. Doing more QE, yeah, probably. Doing QQE like the Japanese do it, and buy equities, also like the Swiss National Bank is doing it. Yeah, why not? But I think that, and that's basically our friend Russell Napier did lots of work on that. I think we should expect much more financial repression. So So money will be funneled into directions where it normally would never go to. I think we will see much more capital restrictions, more financial repression, more government interventions, and then at some point we'll end up in an environment where we say, well, is this still a capitalist system? Probably not. So, I think I will reread Atlas Shrugged over the summer, and it had a big impact on me. I really enjoyed reading it a couple of years ago, and I think it's quite frightening reading it today, probably. But so this is kind of the way forward. And I think what's really crucial is you have to be very, very active as an investor in this environment. I think the times, what were the big trends over the last couple of years? It was obviously ESG. It was risk parity, and it was passive investments. Yeah, so everybody said, well, we don't need active managers anymore. And I think the environment that we are in today clearly shows that active management has a strong use case. And with our fund, with the inflation fund, we're up 70% year to date. I think our combinations of gold
17,
17, yeah.
17, yeah.
Obviously our strategies that combine gold with Bitcoin and cryptocurrencies in general, they have suffered, but they are doing very well. And I mean, the most important thing for us is that our clients, our investors are super happy about our performance. So therefore, I think it's gonna be challenging. But I always make this. People hate me for making sports analogies, but I think it's like with skiing. Austrians, are that's basically the only sport that we're good at. And if the weather is fine, and if you've got fresh powder, and the slopes are empty, everybody is a good skier, even the Dutch. But if it's icy, if it's foggy, then you really can tell if that person is a good skier or not. And I think over the last couple of years, it was pretty easy to make a decent performance in markets, because basically everything was rising over the course of this everything bubble. But now, over the next couple of years, we'll really see who's a good asset manager and who's not. And so for us, that's the challenge that we're facing, the challenge that we're accepting, and we truly look forward to that challenge.
Well, Ronnie, a true Austrian, as soon as you started talking about skiing, I thought I knew which metaphor you would go with, but you had another one. So you have multiple skiing analogies. I've got a lot more questions, but we'll have to leave it there. Ronnie, Mark, thank you so much for joining us. Everyone, thank you for watching. It's been a real pleasure. You definitely should follow both of these gentlemen on Twitter. Ronnie can be found at Ron Steffele, and Mark can be found at Mark Valek. Gentlemen, thanks so much.
Jack, thank you very much for the invitation. All the best, and talk soon.
Been a pleasure. Take care.
There is something that you need to be doing right now, and that is reading the Blockworks Daily newsletter. For top market insights and the latest in crypto news, you have to subscribe to the Blockworks Daily newsletter, and you can do so by clicking on the link in the description to this video, or by visiting blockworks.co/newsletter.